JC, everybody, let's put a little round of applause together for JC for putting this together for another year. Very excited to be kicking it off here. I'm going to keep that webcam on if that's okay, JC, just in the beginning.
Yeah, do you have the, okay, perfect.
Yep, I think I'm good. So thanks, man. Thanks for having me on. Thanks for putting this together. Appreciate it. You know, again, a really good collection of technical analysts, and you know, it's I think it's funny. You know, obviously within our community, I know it's growing, but I can tell you as this bull market presses on, the demand, I think, for technical analysts increases. They don't need us until they need us. Everyone's a genius in a low vol bull market, but you can see the volatility starting to pick up, and when things start going sideways and down. All of the technical analysts you're going to be talking to and today, hearing from, they're going to be a lot more in demand. So when volatility picks up, our business picks up. So I think it's a incredibly timely, it's a great time to have this presentation. So as JC said, thanks for bringing me on. I'll give you a little background the way I approach the markets every single day. I do prefer, I've been doing the Elliott wave approach for about 10 years now, and I couldn't get away from it if I tried. I am a trader. I'll give you a little bit about, you know, my background and stuff like that. I know a lot of you have objections to Elliott. Some of you do, some of you don't. Guys, get your typing fingers out if you could. And let me see, where is our questions? Questions are not visible on my end, JC. See if you can do something.
I can totally see them. I can read them out to you if you'd like. Are you going to take them throughout the session? Or?
I love taking them. Yeah, I love taking them during the session.
All right, so I'll throw them out as they come. Then how's that?
Okay, cool. Sounds good. Questions, comments, insults. I want to hear it all. Okay.
I can do that.
I know you can. So yeah, we'll have some fun here, guys. We'll talk about Elliott, and listen. Some of the biggest objections to Elliott, which I totally understand, I hope to address them, are it's too subjective to be of any use. There's too many rules, et cetera, et cetera. I've heard it all. But hopefully at the end of the session here, I'll overcome those objections and maybe get you to look at it in a different light. We're going to look at live markets. I have positions on right now. I trade live every single day, blah, blah, blah. So just a warning, got to do it. We are talking live capital. We're talking you know, past performance, non-indicative future results. I'm a trader before anything else. I'm not a technical analyst, though I do wear both hats. First and foremost, I'm a trader. I've been trading my entire career. Right out of college, I went to a prop desk in San Diego. I traded before I left college. I'm the first guy to tell you trading's a boxing match more than anything. And the first thing you got to do is keep your gloves up and protect. Okay, you've always got to be containing and managing risk. Never go for the knockout punch. Expect to wind up on the canvas a few times, get up and try to win the decision at the end of 12 rounds. I'm not a get-rich-quick guy, and that's what I love about doing this presentation or this group of analysts. I don't think there's going to be any cheesy sales guys on here, which I love. But there's a lot of that out there in the internet. Please don't fall victim to that. I'm not that guy. Trading's hard. You've got to dedicate yourself to it. Be willing to accept the risk on not only your overall trading account or investment account, but each and every trade. I think you need to be accountable, and that's hopefully what I'll put Elliott Wave. I'll put that in context according to the Elliott Wave approach. So this is I'm going to kind of skip around this presentation a little bit. This is a meld of what I believe to be a major volatility storm coming up. I do think we're coming up in a major resistance. I know JC is going to follow the trend all day long, probably smartly so. I do think there is going to be a period where we're going to come up in a major period of volatility. Is it going to be a crash? Is it going to be a correction? I'm going to kind of just skip through the fluff a little bit and say if you are unprepared for what I think is going to happen, it's going to feel like a crash. But if you're prepared and you're ready, I think it's going to be an environment ripe with opportunity. And this is really interesting to show you, just kind of give you the context of where I think this is going to happen. So this is an interesting indicator that's actually available on TOS, average percent true range. And we all know ATR. It's a wonderful volatility measure, developed a long time ago, used quite a bit. But it's like using notional scale versus log scale on a chart. If you're comparing a Dow 1000 to a Dow 30,000, it's kind of hard to do comparisons unless you switch that log scale on. This is the equivalent of log scale for APTR. The Dow right now is the quietest in terms of average percent true range. How much are we doing high to low on average per month over the last 21 periods? When I captured this chart back in, I think it was October or November, it was at like 4.5%. If you go back, it's the tightest range in the Dow according to average true range on a percent basis in 114 years. Okay, so 1914, we got down to 4.69%, 1954, 4.59, 4.64 when the Beatles came to America, and then I think we hit 4.36, quietest Dow ever on a 21 period APTR. Now, what's interesting is before every major market move, there is a distinct move at APTR that we got to keep an eye on. This is the 87 crash. Look, we came off the low APTR down here, and we started to get a period of increased volatility. Then the market crashes and obviously range expand. So you can see that we're starting to move up off the lows as the Dow was actually rallying up into the top. 1929, exact same thing. You're starting to get an increase at APTR coming off the lows, or APTR low, Dow rallying to the final phase, and then we get the crash. The same thing happened in 2000 and 2007. So what's interesting is we just double bottomed on the monthly APTR, and we're starting to move up. And you guys can feel the volatility in the market. There's a lot of geopolitical things happening. Obviously, there's a lot of things going on, and we're starting to see an increase in that volatility. So I think this is the beginning of the phase where ranges start to increase, trading gets better as we move into a top. At the end of this presentation, hopefully this chart is going to make a little bit more sense, but here's my game plan for the market. Using the Elliott model, which I'll take you through, there is a 5-wave move that is targeting a rather wide zone of resistance from 2,500 to 3,800 in the S&P. Where it stops, I don't know. Don't know, don't care. I'm not wearing my analyst hat right now. I'm wearing my trader hat. I've been long.
The guys are asking, what's the best software to do your Elliott wave charting? Great
question. Let me hold off on that because I don't want people to run over to the website. But whatever, if you want, go ahead. It's the software I use is MotiveWave, and I'll take you through some charts. And it just makes it so easy to drop the labels. And there is some automated analysis to it. There's an automated component to it, but I don't rely on it. But MotiveWave is great. But you can do it on anything. This is Toss. Actually, this is MotiveWave right here. But you can do it in Thinkorswim or all major charting packages that you use. Good question, though. So again, we have a 5-wave move coming up into, possibly we might even see S&P 4000, which, when you go to that log scale, and JC knows that very well, and all the guys on the call here today do, you could see a move in the S&P from 2,500 to 3,800. Though it sounds large in terms of percent of where we've been, it's rather minuscule. Okay, so that's my target. I'm long. I'm continuing to be long, but once we start seeing response from that zone, I'm going to get very concerned, and I think there's a significant pullback coming. Just a little bit about me. I'm Todd Gordon. I run my business, tradinganalysis.com. 2 boys, Jake and Brody. They're almost 4. They're busy, twin boys. They fight all the time. Any of you guys who have sons, how do you get them to stop fighting? Oh, my God. We love them. I run tradinganalysis.com. I've been doing CNBC now for about 9 years. I'm on my third 3-year contract with NBC. And my part-time gig is I'm a co-owner in a distillery in upstate New York, which is kind of fun. Kind of going on. Whiskey and craft spirits are in their own little bull market. Got to throw this one out there. The president knows I'm no angel at all. I live in New Jersey. I'm from upstate New York. We had our reception at Trump National, and Melania and Trump were there. This is my best man, Jeff, crushing me like best men do. And I'm telling you, him and I were no angels growing up, and Trump and Melania in the corner just shaking their heads laughing at all our stupid stories. So Trump knows what a delinquent I am. So anyways, hopefully I don't get deported. All right, let me skip through this, blah, blah, blah. Listen, it's a big task to bite into Elliott in 60 minutes, but let me just touch the surface. Let me show you where we're going. But most importantly, I want you to get the mindset. And not only the mindset for Elliott, but the mindset for all technicals. Okay, with the exception of rule-based algo, I think the market is a big conditional statement. It's a big psychology experiment. And I think to have the proper mindset is really gonna help you in your trading and investing. I love to answer questions. I can't. JC cut me off from those questions. No, I'm just kidding. But he's going to throw those over to me. I love answering, but I do want to keep on time because we got a lot of good content coming. So blah, 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 blah. I'm going to skip that. Okay, let's get into the mindset. Okay, I think this is really, really important before we jump into Elliott. Cavemen. Okay, cavemen would have been terrible traders. So way back, when a caveman would go into an uncertain area, like behind in a cave or behind a tree or something, his mind wasn't developed enough yet to figure out a plan to outsmart whatever was threatening him. So what happened is survival instincts kicked in. And those survival instincts are fear, adrenaline, aggression. This mechanism has not evolved, okay? What that means is when we face uncertainty or we're making decisions with an unwritten path, this tendency to make decisions based on emotion to ensure our survival kicks in hasn't evolved. See, when you're calm and making good trading decisions and doing good analysis, most likely the market's closed. You're using the front part of your brain, which is called the neocortex, which is the rational thought process or thought center of the brain. As the market gets crazy and you got P&L ticking and things are going against you, the decision-making process gets pushed to the back of the brain, which is the limbic system, which is where decisions are made. They did a study, and they actually imaged a bunch of brains doing this, and they watched the activity go into the back of the brain. So your brain is hardwired, according to your caveman tendencies, to make trading more difficult, okay? The less uncertain the decision, the more erratic the decision process came. So you really are fighting your caveman tendency to trade well. So you have to develop EQ. And as I'm telling you and taking you through this little story, I'm going to circle around and show you this is what the wave principle has done for me, has helped to develop my emotional intelligence. Successful people in business and trading have worked hard to address that. And basically all it is not making a decision based on emotion, but on good logic. And there is going to be emotion in trading. I got it. But there's ways to quiet it, and there's ways to use it to your advantage. Okay? So again, embrace that which you can't control. We are literally trying to call the future. Okay, we're trying to be clairvoyant. If it doesn't work, which it probably won't, have a backup plan. Okay, I always go into a trade with plan A and plan B. It's just like life. Do you have your life written out? Do you know exactly how it's going to go? It's probably going to take some twists and turns, so always have a backup plan. When you do make mistakes or get stopped out of a trade, so what? Who cares? It's part of trading. Like, don't beat yourself up about it. Move on, okay? These are ways you can develop your EQ. I just want to get to the good stuff here. I mean, this is all good, just talking about how when the market volatility increases, algos, computer-generated strategies will begin to underperform discretionary strategies, which they've already started doing. So that's all this article is. I'm going to kind of skip through again. This is a little bit more of a different presentation. I want to be real heavy with the charts, so just kind of bear with me. I'm not an indicator guy, believe it or not, as a technical analyst. I hardly ever use indicators. In my personal opinion, I think indicators for the vast majority of the time are a way to mask someone's undeveloped EQ. Okay, to if it doesn't work, oh man, the trade didn't work, let me blame it on this indicator that I bought. Okay, I think indicators have a place of confirming that which you already know. I'm not an indicator guy. Okay, so I consider that to be indicatoritis. This is not this crowd. There is an area out there on the internet where people are selling indicators, promising you the keys to the kingdom. Trust me, that's not going to help. This is all trading is, right? It's 500 sweaty gorillas in a big room trying to read the crowd, read emotion, follow trends, discount data that's going to be happening or released at some point in the future. Don't make trading more difficult than it needs to be. So let's get into Elliott here. The basic patterns of technicals, okay? Triangle, head and shoulders, parallel channel, bull flag, rising wedge, blah, blah, blah. You've seen all of these before, right? Okay, watch this trick. 3, 2, 1. Okay, the basic patterns of technicals are incorporated into the Elliott wave principle, except each leg of a pattern is given a value and an expected duration, certain characteristics we look for. So all these common patterns of technicals are in the Elliott wave approach. It's just we have an idea and we're given context as to where we are. It's an accounting system of trends and corrections. And depending on how late or early you are in the trend will determine how heavily you're allocated or how much your position size or how early we are in the trend or correction. It gives you context to help figure out how to manage your risk. For me, Elliott wave is the best risk management and discretionary trading tool there is. That's all it is for me. If you use it for a long-term projection, forecasting, you're going to get yourself in trouble. So the Elliott wave trend is just, you guys have all seen it. It's a basic 5-wave move. So you go up in one. Okay, you're coming off a long decline. You go up in one. You do your first retracement. That must do less than a 100% retracement. Okay, you get the big breakout move because what happened is you're coming off a high. Everyone expects this move to be just short covering rally before we break to new lows. You go to a deep retracement, 61, 78%, and all of a sudden selling dries up and people are like, oh, damn, what's going on here? All of a sudden you get the breakout. Momentum guys, fundamentals improve. You get the big breakout wave 3. Okay. Sideways in wave 4, and then you get one more push up in wave 5, and that is a complete cycle. Okay, this happens on a 5-minute chart, 15, 60, 120, 240 daily, weekly, monthly, quarterly, yearly chart, all the way through. So again, where we are now in the rut. Okay, coming off the 2009, I think this is the first push up. This is your sideways correction. This is one of the Elliott wave corrections I'll introduce you to. Big breakout in 3, pull back in 4, and now we are targeting one of 2 resistance zones in the rut, okay, into 1600, and then if that one doesn't hold, we're looking all the way up at 2200. Which one's going to hold? Don't know. Don't really care, but I can tell you the NASDAQ's coming up against resistance in the 7,000. The rut is coming up in resistance, S&P into 3,000. I'm going to be taking a couple of shots on the short side. Okay, so let's talk about the wave principle. Not from me, but a couple guys who've been influential in my career. Andrew Baptiste, who's the chief technical analyst at Morgan Stanley and JP Investment Bank, JP Morgan. And this isn't the retail brokerage arm. This is global head of investment banks. This is him playing with my kids, Jake and Brody. He lives about 5 miles that way. He's a good buddy of mine. We hang out quite a bit. He's in Naples, Florida right now, but he retired. And
he looks like Jeffrey Lebowski.
Dude, he is the biggest trip ever. Like, he's an investment bank guy. He would go into the office in New York, and he'd be wearing, like, pink high tops. He's got a ponytail. Like, he played in a reggae band. Like, he's a total trip. Smart dude, though. So he says the wave principle is a simple rule-based methodology that allows the trader to dissect the collective mindset of market participants, for which allows for defined, attractive, positive risk-reward trading. It's a game plan. Tudor, you guys should all know, he's worth over $1 billion, or he's worth over $3 billion. He's given $1 billion to charity. Tudor and Market Wizards, which you guys have all should have read. The Elliott wave principle allows one to create incredibly favorable risk-reward opportunities. They attribute a lot of my own success to the Elliott wave approach. And this is Tudor back then. Obviously, he's added a lot of algo overlays on top, but at the heart, a lot of these guys are still, there is an element of discretionary analysis to it. You guys have seen the Lost Tudor video that he tries to pull down online for the last 15 years. It's him getting ready for the 87 crash, talking about Elliott wave theory. He made 200% return being short for the 87 crash. He estimated to make $100 million from being short in wave 5 for 87. And Prechter, who I'll introduce you to in a second, was a big help in that. Soros in the New York Times saying Mr. Prechter, who again is the modern day ambassador of Elliott, we'll talk about in a second. Mr. Prechter's reversal proved to be the crack that started the 87 crash. This is Soros giving Elliott wave the credit for starting the 87 crash, and that's from New York Times. So we're talking about Elliott wave, and Elliott wave is represented these days by Bob Prechter, who's the head of Elliott Wave International. He's very controversial. I know him. He's a friend. He sees the market coming into a significant period of major collapse. I don't share that pessimism to quite that degree. I have a differing count, but the outlook for the next 1 to 3 years is very similar. Happy to say Elliott Wave is the oldest, I think, market forecasting company in our business. They've been around for 40 years. I just partnered up with them, and this was on their website. So we were doing a whole bunch together with Elliott Wave International. So maybe you saw some of those emails going out. I'm going to skip this. I'm going to play this interview, but Bob is basically talking about what he sees going forward. I'll make this available to you later. I just want to keep on top for our schedule. So finally, we're getting into the charts. Okay. So Elliott is not, it's not a formula. It's subjective, but I think it's a good thing. And for me, which technicals are not subjective? Okay. There are formulaic approaches to the market, but from a trading point of view, I think that has limited utility. I think trading is a big conditional statement where you must say, if A happens, I'm going to do B. If C happens, I'm going to do D. It's a way to control your EQ. It's a way to get context as to where you think you are in the market. If the plan doesn't play out according to what you think, screw it. Get out, contain risk, and move on. Okay, so it's a way to interpret the market patterns that we see all through charts, which you've looked at forever. Fib will help you identify the beginning and ending of these Elliott wave patterns, okay? Some say it's too subjective. Unfortunately, those are people looking for the magic bullet to trading in life. If you find a formula for success in life besides hard work, send it to me. Okay, unfortunately, guys, you've got to just get punched in the gut a couple of times, do a lot of hard work, take your lumps, and just keep pushing forward. I wish it was more elegant than that. So what we're looking at here is this idea that the 5-wave move that we talked about, okay? Let's just go through a couple of the quick rules, and then we'll move into some chart examples here. So when you're coming off a significant high, you get the first push up. It's a little 5-wave move, okay? Everyone who thinks the market's going to new lows, sentiment is horrible. Fundamentals are horrible. Everybody who's short already, who wants to be short already is short. You get the first 3-wave pullback. It retraces less than 100% of this. So people are like, okay, we're just going to new lows, no big deal. All of a sudden, the breakout happens, and everyone's like, oh, God, what just happened? You get the big breakout. Price action leads fundamentals. You guys know that. Then you get the pullback in wave 4. Wave 4, the first correction can't break below the prior correction, okay? Now, that's pretty intuitive, because if you're in a good uptrend, obviously this correction should not break the prior correction. And how do you know, that this is a 4 and this is a 2? And I know a lot of you are thinking that. There's 2 answers to that. One, there's specific corrections you're going to look for in the second wave, and there's specific corrections you're going to look at in the fourth wave, the shapes. Number 2 answer to that is you're just looking for the 2 biggest corrections within a trend sequence. You're looking for the biggest corrections, both in price and time. That's going to give you an idea that you're in a second and fourth wave. Okay, next rule is of your trend waves, 1, 3, and 5, 3 can't be the shortest trend wave. Okay, you can't have a long 1, a long 5, and a short 3. It just doesn't work that way. Those are it. Okay, and when you get started counting Elliott, I'd take a screenshot of this and just print that out and just paste it right above your trading computer, and you're going to be good to go. Okay. So again, wave 2 can't break below 1. Wave 4 can't break below 2. Wave 3 can't be the shortest. Okay, those are your trend rules. Now, let's just take a look at some setups. Now I do actually have a program. I hate to say this, as much as I've been bagging on indicators, I do have something on Thinkorswim that does automate the wave 4s for you. So you look up in 1, 2, pull up in 3, and this does actually calculate a wave 4 support zone, and then you're trying to catch the wave 5 move up. Okay. This is Goldman. 1, 2 actually took this setup. 1, 2, rally up in 3. Wave 4 does not move into the territory of wave 2, and you're going to get a push up. Okay, now let's keep this in mind. Wave 1, this looks to be longer than wave 3, and we could do a quick fib projection to measure that. If that's the case, let's say that's $18 and that's $25. If this is correct, wave 3 shorter than 1, wave 5 must mean that it's got to be shorter than 3. So 5 would be the shortest, 3 is the middle, wave 1's the longest, which is completely fine. And I'll tell you, a situation where you usually get a long wave 5 is like commodities. Commodities tend to end in huge major blow-off tops like crude oil, because commodities usually rally on like feasts or famines or war, geopolitical shock. So usually in commodities, you get those long wave 5 blow-offs, just like crude did into the 180 or whatever, 160 or 180, whatever the top was. So let's kind of talk about this idea that Elliott's fractal, okay? So the 5-wave move, we went through that enough. Each of your smaller waves, 1, 3, and 5, will break down into this pattern, but on smaller degrees, okay? 1, 2, 3, 4, 5, and 1 down in 2, 5 waves in 3, and this is what we call triangle 4, 5 and 5, okay? So before I bring in live charts, let's just kind of go back to this point. Where do you start the count and where are the corrections? Well, I like to look at a completed Elliott trend to get context. And the way I figure out when a trend is complete is I like to see 2 good-sized corrections. I see a good-sized correction here, and I see a good-sized correction here. I have a little indicator I can give to you, it's no big deal, that paints a swing high and low. If a swing high is not broken by 13 bars before and 13 bars after, it's given a blue dot. Blue dot high, blue dot low, blue dot high, blue dot low. So 13 bars before, 13 bars after, it's given a blue dot. Just a significant swing point in the market. That's usually a good little visual aid to help figure out the beginning and end of your corrections. So there's wave 2, there's wave 4, and we're moving up. And this is the rut, okay? This is the Russell, all right? So 1, 2, 3, 4, 5. I captured this when the rut was 1440. So let's get inside this orange 4 to orange 5. Okay, orange 4 to orange 5. From 1000 rut up to 1440. 1000 rut. Here's orange 4. Look, where are the 2 biggest corrections? Well, there's a big nasty one here, and I'm sorry I mislabeled this. This should be 3, and this should be 4. Sorry. It should be 1, 2, 3, 4, and we're moving up in 5. So right now, I do think we're in the wave 5 of 5 corrections. So we've got a big correction here, sideways correction here, 5 of 5. And look where we are in rut, 16, 17, 1800 rut. We're coming up into what I think to be the end of that move.
Todd, what would be the projected target on that 5th wave on the Russell 2000?
For the rut, let's take a look. And this is the software that I use. Let me just downscale this. I got a couple 4K monitors, and I drop it down to 1080 for the presentation. Okay, so here's where we are in the rut.
I have no idea what that means.
Did you get those monitors I told you to get?
I don't think so, not yet.
Come on, you'll have to wait for Christmas next year.
So what would be the projection on the 5th wave? Was my question.
In terms of the top side?
Yeah, the guys are asking in the chat too.
Okay. So here's rut on the weekly, okay? And the rut from the weekly, sourced from the 2009 though, 1, 2, this is what we call a flat correction. I'm going to try to introduce you to the corrections. Again, this is the key to figure out where we are, identify the corrections, up in 3, down in 4. Now here's what's going on. Wave 4 started in 2016, this green 4. We are now doing the 5-wave move inside of 5. So we've got a bunch of fib in the rut, resistance 1500 up to 1889, and we're just in the bottom third of the zone. I would bet almost anybody we are going to see at least a 20% response while below 1850 in the rut. And there's a ton of fib in there, okay? And what all these fib are is basically just studying the distance traveled in each of these swings to help figure out where this guy might go. The other thing I want to...
The 1700, Todd, is the 261.8% extension of the entire 07 to 09 low.
Oh, from right here?
Yep, that's the 261.8 is at 1700. So how do you incorporate those Fibonacci extensions, like for example, in that case, in Elliott wave? Because that is Elliott wave, right?
It's 100% Elliott wave. I'm so glad you just said that. So on the software, so if we go ratio analysis, we're going to go 5v4. Okay, so 5v4. So if you look at this distance, 2009 crash, as you brought up, 862 to 342, if you switch to log scale, okay, I have us 161% of this percent drop. Okay, and you and I were talking about this. I think when you're looking at these such big numbers like this, you need to look at the percent change. Whatever percent change that is, multiply that by 1.618, and that's going to be 1506. Double that is going to be 2137, 200%. Now, if I take it off of log scale, the fib is going to change. And this is what I think is super key. And my stuff's going to look all kind of jacked up here. But if you do a notional fib, what JC's saying is, okay, and I took log scale off, you take this distance, point travel, multiply it by 2.618, that gets you 1686. Okay, and I think that's really, really key. So let's keep that in the back of our mind, 1686, put it back on log scale, straighten our charts out. 1686 is going to be right there. Plus, I've got a bunch of other fib as I pull in the smaller degrees. You know, there's a lot of resistance here. And JC, 1700 is going to be tough. If we don't hold that 2.618 notional fib extension, as you mentioned, I think the next cluster is going to be up here around 2100. So if we're wrong, so what? I'm going to get long, and I'm going to try to ride the upper end of this channel. The other thing I would say is Elliott is wonderful in helping you figure out where to draw channels. A traditional Elliott channel, to pick out a wave 5 top, the way you do it is you connect wave 2 low, wave 4 low. Okay, so you take this channel, you connect 2, 4, you then project off the wave 3 top. Okay, that's usually how you get a wave 5 top. To boot, what you're saying, if that 2.618 notional extension comes in, it's going to correspond with this parallel wave 2, 4 channel. There's a lot of resistance right here. Do you think it holds, or do you think we break?
I think we're going higher in the Russell 2000.
Yeah.
I think we're going higher in stocks. So yeah.
Yeah. You know, for me, and that's the line I want to draw. When I go on CNBC and you go on Fox and you go on the different things, we've got to put our analyst hats on. But when I'm coming here to trade, and I trade my own capital every day. I mean, here's my account. You know, here's all. We took a lot of profits yesterday. I mean, this is all my the 2 accounts I trade for customers. I don't care where the market goes. I really don't. I'm trying to find good opportunities to set up low risk, high reward trades. Any other questions, or good to go there?
You know what? Can you talk a little bit more about the risk management of that?
Yeah.
Right. So like we talk about the upside and everything like that, right? But as I always like to say, like I don't give a damn where you think it goes. I want to know where you're wrong, right? At what point between where we buy it and 0 do we say, hey, we got it wrong?
Yeah. Okay. So if you want to talk about the rut, which I'm totally on board, like here's where I have this is the daily rut. So we're coming off a November 14 low. So I think this is a higher degree wave 3. Okay. And again, let me just show you the software. So you got to have some knowledge of Elliott, but if you just right click and go decompose as an impulse, it tries to do the calculations for you. And sometimes you have to kind of help it out, which again, give me 2 weeks of study and you'll be fine. I think this is the wave 3 moving into a wave 4. Now, if you want to be long for the rut, okay, you can be, but if your analysis is right and we are in a 4th wave here, we should have one more push in wave 5. So it gives you an idea that, okay, we're pretty extended in this move from November 16th. I don't want to stick in this thing too long because that's going to complete a higher degree 5th wave. How far should the wave 5 go? We just go ratio analysis and you just do 3 studies right here, the 3 wave 5 studies. Number 1, pin it. Number 2, pin it. And number 3, I forgot to pin it. Pin it, and you're just coming up with a zone of resistance. Okay, so where's the cluster happen? Well, there's a little cluster around 1640, 1660, and then again at 1680. So number 1, if you want to be long, fine. I would structure your trades, structure your options trades. I'm a big option trader. I might be buying the 1600 calls, selling the 1650 because there's wave 5 resistance. If I'm right, the market will then pull back into wave 4. If I'm wrong, we are in a higher degree wave 3, and one of the rules is oops. I just blew it up. Oh my God. Whoops. Hold on, stay with me. I was just gonna bring it home and make my awesome point. There we go.
You were just so on fire, the computer couldn't handle it. You know
I
what
know.
I'm
Hold
saying?
on. I can pick it back up. I can save it. I can pull it in.
You can't stop. You can only hope to contain you.
All right. So, oh, there's a hockey. Oh, shoot. Hold on. I know what I did. Stay with me. Okay. So if based on our idea, if we want to take 1600 up to 1650, where are we wrong, JC asked? Being that the higher degree wave 3, okay, within your wave 3, you want to see a good clean 5-wave move. And a good clean 5-wave move is going to be 1, 2, an extension in 3, pull back in 4, which it could even be this. Okay. And I have a feeling it's going to be that. So whenever the pullback comes, if we get below 1560, I'm going to label this as wave count invalid. That's a stop loss, okay? If I think this is a higher degree 3, we're pulling back in 4 at some point. As long as we stay above here, we should be able to reach 1650, maybe 1680. So then you ask yourself, at 1608, I'm going to have 48 points of risk. I've got 50 points on the upside, and if this zone gets in, maybe I got 80 points of zone. So 80 points of room. So you ask yourself, is that a trade you want to do? And that's why I love trading options, because I kind of think we are heading into this 4th wave. Why is that? Because this wave 3 is going to break down into 5 smaller waves. This correction does not look to be the same depth and duration as this guy right here. This guy looks pretty deep, okay? These corrections, this little sideways guy and this little guy here, look to be similar depth and duration. So I'm going to say the higher degree 3 breaks down into 5. I put a trade on yesterday in the SPX, which is this, based on this outlook. I put an index butterfly on, okay? I sold the 28.25 puts, 28.90 puts, 27.25 puts, okay? I put that trade on, which is going to take advantage of what I think to be a sideways correction for a couple weeks, okay? I think we're going into this sideways wave 4. The wave 4 can hang out as long as it wants. I'm long theta, short premium, which is a great way to trade corrections with Elliott Wave. As long as we stay above 1560, man, I'm good. And then when the correction's over, it's traced out one of the Elliott corrections. Then I'm going to get on board for the wave 5 move up. Like, if I'm wrong, I'm going to say to myself, so what, man? It was a well laid out plan. I know where I'm in. I know where I'm out. I'm going to contain my risk and get on it. Listen, as long as I did the work, I'm not going to be pissed off. There's nothing more that pisses me off than putting a trade on that wasn't researched and I lose money on, because then you don't know where you are.
Agreed. Where people are asking, Todd, before we let Dan Russo come in,
Yep.
Where can people learn more about Elliott Wave? What do you suggest that they read? What sort of resources do you think are the most valuable?
So, boy, what a softball question that was. Yeah. So I mean, obviously, I'm being that I was chosen by Elliott Wave International. I think Elliott Wave International is a wonderful resource. MyBusinessTradingAnalysis.com. We are their premier. We are their only trade advisory business. So my website's TradingAnalysis.com. We have a ton of information on Elliott. I've got a video here explaining kind of our relationship and how I approach Elliott. I trade cryptos very actively. I found Elliott to be wonderful with the cryptos, because it's just picking up volatility and emotion. That's all we're really trying to do here, guys. So cryptos are great. You can take a trial here at TradingAnalysis.com. We have our stock service and we have our crypto service. Have a look there. This little video will pop up in a second. So have a look there. So best thing to do, guys, is definitely just check out. I have my free videos right here. So this is an actual Intel trade I did live this week for our members. We did an Intel earnings trade with Elliott and options. So there's a video there. And then what time am I off, JC? I'm off at 10 or 9:45?
We're getting Dan now. You want to finish up another 5 minutes, kind of round it out and show people, why Elliott Wave is so awesome. I mean, that's really the bottom line. I mean, people, to me, I find it kind of difficult to ignore at certain times, because these waves kind of, like, it's impossible not to count them. But I'm not the guy counting, as much as and as frequently as you. What is probably some of the best reasons to use this tool?
Again, it's context. Like JC, I mean, how many triangles have you looked at in your life, right? How many 1,000 triangles, and it's lower highs, higher lows. It's a 5-point swing. When you see a consolidation, like, okay, wouldn't it be nice to know in Alibaba on the daily that is a 5-pointed Elliott triangle, A, B, C, D, E. And what if I told you that an Elliott, a triangle, when you have a long trend, usually occurs in the fourth wave? Okay, so what that means is if everyone sees a sideways triangle, anybody who's ever read Edwards and McGee is say, oh my God, I found a triangle. Let's pile in on this breakout in Alibaba. I'm going to make millions of dollars. But if a triangle more often than not happens in a fourth wave, which means the higher degree, the post-triangle thrust is usually wave 5, you can be in and you can be out quick. Okay, don't hang around. So it's all about having context. If you see an ABC zigzag, which is a very common pattern that we all know and see, it's just a very straight, simple to the point correction. Usually that means that we're in a second wave and a third wave breakout is going to ensue. And if you see the gaps in the price, that usually suggests that you're in a third wave. So then we get the fourth wave correction, you say, okay, don't hang around here too long. Next week, we're going to be looking to trade Alibaba on earnings, February 1st. So I think we are doing the fifth wave move. And let me just take you through here. So here's 1. Here's your wave 2. We do not break below the beginning of wave 4. We have a 61% retracement, which is textbook. That's why it's color-coded green. Wave 3 ongoing. Usually wave 3 is longer than 1, so that's why we just beat the 100%. We're coming into the typical wave 3 projection, which is 2618. I expect a bit of consolidation in wave 4. Heading into earnings, I'll be selling put spreads below wave 4 support for the little push up here into 220, 230 for earnings next week. If it's wrong, it's fine. I'm going to contain my risk. But the biggest thing about trading with Elliott or anything you guys hear today is to have a plan going in. Have it plan A, have plan B. If it doesn't work, have a contingency plan and control that risk and get out. Because technicals are great, but they only help you as far as timing your trades and managing risk. And that's where fundamentals rely so heavily on technicals, and that risk management, capital management, timing a move is so very, very important. So, guys, thank you very much for checking out.
I really like how you did that, Baba, Todd, and explained kind of the process and the wave through that. That was helpful.
Okay, good. Thanks, man. Appreciate it very much. JC, thanks for putting this on. I hope you guys have a great day. Check me out at tradinganalysis.com. You guys have got a lot of good content coming. So, JC, thanks for having me.